In today's episode, I'll talk about three interesting stories. In the first story, I'll talk about what SEBI's recent board meeting meant for investors like you and me. In the second story, I'll talk about OpenAI's new investments and what it means for the larger AI world and the investors looking at it. And in the third story, we'll take a look at if India is really working hard with respect to data from the recent PLFS survey. Welcome to the Daily Brief Show by Zerodha, where our aim is to give you news in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 3rd of October. So let's start by talking about SEBI's recent board meeting that was held on September 30th. This is where India's market regulator sets the tone for how things are going to run, and any changes that they announce ripple through the market and affect investors, traders, and companies. This time, the focus was on some new updates aimed at making the markets easier to navigate, especially for retail investors like you and me. Now, SEBI unveiled 17 key changes, but let's zoom in on the ones that will actually impact your investing experience. And that is because a lot of the updates are more relevant to companies and industry players, so let's just stick to the highlights that make a difference for those of us directly involved in the market as retail investors. I'll start by the first one, which is new options for stock market trading. You know how when you trade right now, you need to transfer money into your trading account before placing an order? That is going to change. Starting February 2025, SEBI is rolling out two new mechanisms for trading in the equity market, which gives you more control over your money. First is UPI block mechanism. Just like in IPOs with the ASBA process, the money stays in your bank account and is only blocked until the trade goes through. So if you don't end up trading, your money stays untouched. And the second one is 3-in-1 trading account. See, your savings, demat, and trading accounts will all be interlinked. So no more moving money back and forth between these accounts. Now, the question is, why does this matter? Look, it means more than just convenience and safety. Your money stays with you until the trade is confirmed, which reduces unnecessary hassle of shuffling funds between multiple accounts. The second change that SEBI made was T+0 settlement. Look, right now, if you buy or sell shares, it takes 1 day for the transaction to settle. This means your money or shares arrived in your account on a T+1 basis, which means trade day plus 1 day. SEBI had previously tested the idea of T+0 settlement with a small set of stocks, and the feedback was pretty positive. So now they have decided to expand this to the top 500 companies. The question is, what does this mean for you and me? Look, if you sell shares, you will get your money or the shares by the end of the same day, which gives you quicker access to your funds. For traders who need fast liquidity, this could be an absolute game changer and could really amplify your strategies. The third change was easier registration for investment advisors and research analysts, or IAs and RAs. Now, here's an interesting statistic. In a country with around 10 crore unique investors, we have less than 1,000 registered investment advisors today. Why so few, you might be wondering? This is because the current regulations are so strict that it discourages a lot of people from entering the playing field at all. But now SEBI is changing that by making it easier for new advisors to get registered. No prior experience is required anymore. A basic graduate degree is all you need. Plus, advisors will not have to retake certificate exams once they have passed the first one. Now, this should result in more and more advisors entering the market in the future, and it could make quality financial advice more accessible to everyday investors. By the way, in case you're interested in a deep dive on how these new rules might reshape the entire advisory landscape, we've got an episode exactly for that. Check out the link in the description. Back to the story, the fourth change was faster rights issues. See, for companies looking to raise money, rights issues have been one of the slowest processes in the past. It takes an average of 317 days for companies to complete this, which is almost 1 year, and that is absolutely crazy. SEBI has now shortened this timeline to just 23 days, which gives companies a much quicker way to raise capital. And for investors, this means faster opportunities to buy more shares in companies you already own. The fifth change was new mutual fund products. See, traditional mutual funds are great for safety, but they lack flexibility. On one hand, portfolio management services, or PMS, offer a lot more control, but they come with higher risk, and they are usually reserved for the ultra high net worth individuals. SEBI's solution here is a new mutual fund product altogether, which sits somewhere in the middle. It offers more flexibility than regular mutual funds, but keeps the strong regulatory safeguards in place. The key features are minimum investment of 10 lakh, no leverage allowed, which means fund managers cannot borrow money to invest, and limited derivative exposure of up to 25% of the portfolio. Now, this gives wealthier investors a way to take on a little bit more risk for higher potential returns while still staying within the safety net of regulated products. The sixth change was mutual funds light for passive investors. Look, not all mutual funds are created equal. Some are actively managed while others like ETFs or index funds are passively managed. Right now, all funds are regulated under the same framework, but that is about to change with SEBI's new rules. SEBI is introducing a lighter regulatory framework for passive funds, which makes it easier for fund houses to offer them. Passive funds usually have lower fees and are easier to manage, so this change could lead to more options for investors who are looking for a straightforward way to grow their money. The seventh and the last change we will be talking about is easier nomination process. See, nominating someone to inherit your investments has always been a bit of a headache. As of the current situation, you can only nominate up to 3 people, and the process of transferring assets can involve a lot of paperwork and delays after the account holder's death. SEBI is now simplifying this by allowing investors to nominate up to 10 individuals across different accounts, and they are also cutting down documentation requirements. Now, this should make it much easier for families to inherit investments without unnecessary delays. Moving on to the second story, let's take a look at OpenAI's financials and understand why they have been getting so much attention as of late. Look, according to reports, OpenAI will generate around 3.7 billion US dollars in revenue this year. Now, this is quite impressive, especially for a company that has only been around since 2015. But things get even more interesting when you consider their losses. OpenAI is projecting losses of nearly 5 billion US dollars this year. And the reason why I'm mentioning all of this right now is because this serves as a huge reminder for all of us about just how expensive it is to build, run, and scale cutting-edge AI technologies. Now, the thing is, even though OpenAI in specific is making big losses, it is able to sustain itself because it has been able to raise funds constantly. Currently, OpenAI is on the verge of closing a massive funding round of 6.5 billion US dollars, and this will value the company at a mammoth 150 billion US dollars. But there is more to the story. OpenAI has recently hit a rough patch. Just last week, their Chief Technology Officer or CTO, Meera Murati, resigned unexpectedly. And she's not alone. OpenAI's Chief Research Officer and VP of Research have also recently left. And that is not all either. Earlier this year, OpenAI also lost a couple of co-founders and top researchers. Now, I'm sure this gives you a very good idea that this is not just about a few people leaving anymore. It is starting to look more and more like a mass talent exit from OpenAI. Also, a recent Wall Street Journal report said that OpenAI might be struggling with something even deeper. For those of you who do not know, OpenAI recently shifted its model from a non-profit research lab to a profit-driven business, and this is apparently causing some real tension internally. There is now talk about rushed product launches, concerns over safety testing, and skepticism about whether AI can actually live up to the grand promises it has been making. Some employees are also worried that this push for commercial success is overshadowing OpenAI's original goal, which was to develop safe and beneficial AI systems. Now, let me take a small step back from OpenAI for a moment and talk to you about the bigger picture in general. See, things are not exclusive to OpenAI. The interest in funding AI companies has been rising quite rapidly worldwide. To give you some context and background, in Q2 of FY 2024 alone, AI companies raised a record 23.2 billion US dollars, and that is a 59% jump from the previous quarter. And that's not all. Even the average deal size is climbing. Last year, the deal size was 18.6 million US dollars, and now it is 28.9 million US dollars. And if you are interested in some more astonishing numbers, since 2020, the AI sector has attracted 280 billion US dollars in investments, and $91 billion of that amount came in 2021 alone. So in a manner of speaking, it is safe to say that we are in the middle of an AI gold rush. Now, as a result of all of this, the world's biggest tech giants, Microsoft, Google, Amazon, and Meta, are all doubling down on AI infrastructure. These companies have increased their capital spending by 50% this year to over 100 billion US dollars. Some analysts say that this could increase to over $1 trillion in the next 5 years, which is a mind-boggling amount of money being poured into data centers, chips, and AI hardware. But the catch is, despite all of this massive spending, revenue has not quite caught up yet. David Kahn of Sequoia Capital points out what he calls a $500 billion hole in the AI ecosystem. That is the gap between the massive infrastructure investments and the actual revenue growth AI is actually producing in reality. In a way, it's like we built a huge highway, but there are no enough cars on the road yet. Now, the rate of adoption of AI might explain the theory behind all of this happening. See, the latest data from the US Census Bureau says that only about 5% of American companies are currently using AI to produce goods and services. That is actually down slightly from earlier this year. Even in tech heavy industries, adoption is somewhere around 10 to 20%. The information sector is leading, but even there, it is only about 30%. And for individuals, about 39% of Americans between the age of 18 and 64 have used generative AI, but those aren't the adoption rates you'd expect from all the hype we've seen around us. So, despite all the enormous investments, there is not much to show for AI beyond some efficiency gains for developers. Even Nvidia, which is one of the biggest winners in the AI boom, has seen its stock take a sharp correction recently. According to an MIT professor, AI's economic impact over the next decade or so might be far less revolutionary than what many of us are predicting. His estimate is that AI will only boost productivity by about 0.5% and GDP growth by just 0.9% over the next 10 years. And that is probably far, far away from the world changing impact than some people have been predicting. Goldman Sachs' head of global equity research went even further and said that for AI to justify its enormous development and operating costs, it needs to solve complex problems, which in his view, it is not built to do. He says that truly revolutionary inventions like the internet enable low-cost solutions to disrupt high-cost ones even in their early days. AI, on the other hand, is incredibly expensive and is still struggling to find cost-effective applications. So while there is an enormous amount of excitement and investment pouring into AI, real-world applications and revenues are lagging far, far behind today. It is maybe somewhat similar to the early days of the internet boom or even the recent crypto madness. No doubt, the potential is huge, but it might take longer than many of us expected for AI to truly transform businesses and generate significant returns for us. Moving on to the third and the final story of the day, let's understand if India is really working hard. See, the government recently released its latest Periodic Labor Force Survey or PLFS, and the headline from it is that India's unemployment rate has remained steady at 3.2%, which is the same as last year. Now, let me explain what this means and why someone like you or I must really care about it. See, the unemployment rate measures the number of people who want to work but cannot find a job. It does not really include those people who don't even want to work in the first place. Now, this is important to remember, and that is because if you focus too much on one single figure, you might miss another key points. And that is, are there Indians in the working age who aren't even trying to work today? See, there used to be a lot of people in that category back in 2017, 2018. In those years, only about 50% of Indians over 15 years of age were in the workforce. But today, that number has jumped to 60.1%, which is just short of global averages of 60.8%. So, in the last 5 years, India's workforce has grown by about 20%, which is quite a good achievement. And the real driver behind this shift is women. To give you some context, in 2017-2018, just 23.3% of Indian women were part of the workforce. And today, that figure stands at 41.7%. Now, this sounds like a great thing, and in some ways, it absolutely is. If more Indians are working and the unemployment rate stays the same, it means we are creating jobs. But there is more to the story, and it hints at some underlying distress in our economy. Let me explain. See, employment numbers only tell us so much. If you worked in any kind of job before, I'm sure you know that not all jobs are equal. Some are meaningful and productive for sure, but the others are pretty much just time pass, if I could put it that way. Now, this has been a persistent issue in India for a very long time. We are a country with many poor people, and for many people in India, not working isn't quite an option. Only the wealthiest, most educated Indians can really afford to stay unemployed and wait for the right job for themselves. Most people will take any work that they can get just so that they can survive. But that does not mean their work is valuable or well paid. Many people are underemployed or stuck in what's called disguised unemployment, which is basically that they've got a job, but they aren't really needed in that job. Employers only hire them because they can afford to hire them due to the wages being very low. Now, this is especially very common in family run businesses. Families usually ask members who aren't doing too much to help out for little or no pay whatsoever. In statistics, these workers are classified as self-employed, but self-employed workers typically earn less and work fewer hours than salaried employees. And interestingly, there has been a rise in self-employed workers as of late. This trend is particularly evident in agriculture, where many families employ extra hands to take care of odd jobs around the farm. Agriculture for a very long time has been a hotspot for disguised unemployment in India. It is where people go where they cannot find better paying work. And the numbers show it as well. Agriculture employs about half of India's workforce, but only contributes less than a fifth of the country's economic output. That means it is highly inefficient compared to other sectors. Worker for worker, other countries get a lot more from their agricultural sectors than we do. And because of its low productivity, farming does not pay well either, but it still accounts for 60% of all jobs in rural areas in India. Traditionally, many men would leave their villages to work in cities and send back money to support their families. But COVID-19 disrupted all of that. The pandemic caused a lot of jobs in cities to vanish, and it cut off the flow of money to rural homes. And at the same time, rising inflation meant that families needed more income just to survive. As a result, since 2021-22, the share of workers in agriculture has actually increased from 45.5% to 46.1%. And that might not really sound like too much, but it represents tens of millions of people in India. What is interesting is that most of these new agricultural workers are women, many of whom are self-employed. Meanwhile, the share of men in agriculture has dropped significantly. One possible explanation is that men are heading back to the cities in search for more stable jobs, while women have stepped in to keep their households afloat in the meantime. Now, for your information, this entire situation is not unique to India. Across all of Asia, women often act as buffer workforce. They take on flexible and casual jobs when economic conditions are tough. They're usually seen as secondary earners in their families. And that for sure needs to change. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.